Hello and welcome to today's video. So we are going to be talking about the Trump economic plan for 2025 and beyond, and how specifically you should think about investments and invest in 2025 and going forward. We're going to explore things like tax cuts, the best sectors to invest in, what to avoid as well, personal financial strategies to keep your health growing, and ultimately some actionable items and tips for you to take away. Now, let's take a step back. You need to listen to this if you don't want to lose your investments in 2025. We want to be aware that in 2025, a number of things are going to change. Tariffs, focus on lower taxes, deregulation, as well as boosting traditional industries like energy, mainly oil and gas, specifically for domestic produced products, as well as industries and employees that they serve. So this is going to change also for you as an individual if you're working at a company, as well as if you're a business owner. So we're going to go through a number of these things in this episode. So stay tuned. What I wish I knew when I started preparing for, different law changes for this year, it would be to act earlier and prepare for the worst with systems. So we're going to go through a number of different things that are going to change for 2025 and how to proactively be aware and combat them. First things first is going to be qualified business income deduction. That's going to phase out. Something to talk to your CPA about, or also a financial planner, wealth manager. And it's something I am very focused on in my investor group that I made. So I'll put a link to that if you want to apply, where we give insights for business owners and entrepreneurs with the latest tips, best actions to take, and most impactful resources for you. Individual tax brackets are going to change. It's projected that they're going to, increase unless something is otherwise done. And so how are we going about preparing and saving for these additional increases, as well as working with our tax strategists and professionals to offset those taxes so that way we aren't forced to pay that increase in tax bracket changes. We want to be aware of estate tax exemptions, as those are pretending to be cut in half, specifically for those who have family members who aren't, or who are planned on, passing soon, or maybe who have health issues that could be the case. It's really something important to think about. So talk to a legal professional, as well as an estate attorney and other individuals like your CPA to plan for some of those things. The big key takeaway is that different states have different estate and inheritance taxes. So it's not just the taxes of the nation, but it is also state and situation dependent. So keep that in mind, because that is imperative, especially for some states I know have a variety of different rules and laws as it relates to different levels and amounts and how that goes about, right? And then the last thing is going to be opportunity zones. So these things are set to expire in December 31st for 2026. Now, why I wanted to include it in this episode is simply because 2025 is going to be an imperative time for you to take action on it, because of the ultimate deal cycle that real estate takes. We want to be on the leading edge, because it is my belief that next year, as people are still aware of these, prices could potentially increase, which would cause challenges for you, as well as you might not be able to close on a deal. So keep that in mind. If you're a small business owner or managing family finances, these changes could definitely change your tax bill. So planning is crucial. Also want to consider having a bookkeeper, right? That's something that's really imperative. And I'll also put some resources for that as well. That way you're able to proactively understand what to invest in and how much you can, without one, completely breaking the bank, but also making the decisions to understand what might need to change. And if you actually have those funds to invest in, or if you're potentially cash flow poor and shouldn't make, these types of investments, even though you think you have that 100 grand in the bank, you're, slowly losing money from different investments because you're not paying attention to it. Now, when we think about tech, we're going to be talking about AI, cybersecurity, and cloud computing. Energy is going to be oil and gas. And with finance, we're going to be looking at a number of different sectors and aspects that are coming into play in terms of regulation, changes in terms of customer experience within banking, and finally with cryptocurrency, Bitcoin and Ethereum. These are going to be big topics, as this presidency is the most pro cryptocurrency we have ever had. Okay, so let's go into this. But before we do, keep in mind that there with every investment, there's risk. So tech stocks might be overvalued. Inflation could eat into returns. Diversification is definitely a safety net, but most experts are thinking there's not a recession in 2025. There's a number of reasons that could be the case, but ultimately, especially as tariffs come into play, keep that in mind, especially if you're a current employee in a company, to not over leverage and over invest all either liquid assets. So think of like your savings account, checking account, things like that, as well as do not intentionally prepare on those cash savings offsetting your current expenses. The best way for 2025, if you're looking to leave your job, is going to be two things. It's going to be reducing expenses, one, and then it's also going to be not having to actually rely completely on some of those investments that you're making for the cash flow that they produce. So let's dive into this a little bit more. We're first going to go into tech. So when we think about AI, cybersecurity, and cloud computing, we know that data centers is going to be a big piece. We know there's a lot of competition currently within DeepSeek and ChatGPT, as well as other LLM models. Cybersecurity is always going to be a big thing, especially as we have a number of these additional things put into play. And so keeping in mind the risk aversion for cybersecurity. So maybe even getting insurance if you do have a business. And with AI and cloud computing, as we think about investing, we want to invest in things that are produced from a value standpoint, not necessarily a perception standpoint, right? So we've seen how, for example, Tesla stock has gone up and down because it's a belief of what's happening. That's not necessarily the best strategy because it's not rooted on an actual foundation of what it is. Similar to when the United States got off the gold standard, everything became perception in terms of how it would return and wasn't actually backed by anything. So keep that in mind as you're looking to either specific companies or overall these industries holistically. We can see how, especially with AI, things can drastically change simply overnight at this point with how much impact there is. Think of DeepSeek, right? And how that's come into play, or even TikTok ban and how that, rattled kind of the industry earlier this year. Now, in the early part of 2025, we've already seen some layoffs from a variety of different companies, and there's several different factors that are going into that. So keep that in mind for your industry or your position and how that will be impacting you. Simply could ask your manager to understand what the projections for the year is, how you can ensure that you can not only keep your job, but continue to be a valuable asset where your job isn't even considered to be on the line. But if the inevitable were to happen, ultimately have that sort of exit plan, because the worst thing that could happen with a possible layoff is that you're over leveraged with the investments that you make and put too much into things that don't have viable, again, asset-backed investments, right? Of which you're just purely relying on the speculation of it. So this is also something with Bitcoin to keep in mind. Traditionally, we only want to put maximum of about 5% of our net worth or even liquid cash into these types of investments. So when we think of net worth, that's all assets minus all basically debts, right? It's also dependent on how much cash reserves you have and what you're investing in. So here are the three things that you need to know about cryptocurrency and energy investments as it relates to investing in 2025. The first is going to be the changes in tech with how they're valued and also their potential returns, energy, specifically with oil and gas resurgence, and lastly, with cryptocurrency. This is the most pro-cryptocurrency presidency we have had to date. And there's a number of things that are changing in the finance, banking, and fintech space, in addition to overall cryptocurrency holistically. Now, as we look into these specific industries, we want to keep in mind what the possibility and potential is. So as we look at tech, we think about AI, cybersecurity, and cloud computing. We've seen how AI can drastically change in the matter of a couple of weeks or even sometimes a couple of days with a new product or service coming out, for example, like DeepSeek that came out earlier this year in 2025. This is just a testament to say that not all AI company or really tech company is safe simply because you can offset the potential market share or impact and the users that are using that platform almost instantaneously at this point. And so as we're thinking about investing in sheerly AI isn't the most sound investment. Just like when the United States was initially focused and was backed by gold, that made sense, right? Or you have Marriott, for example, who's backed by real estate, right? That makes sense as you look at their net operating income, their overall expenses, and their overall valuation. As we think about companies like Uber, Lyft, Tesla, things like that, they do have some assets. Now it depends on the type of company, but they do have some assets, but it is largely bet on speculation. That speculation fundamentally then means that there's a lot of volatility, or at least the potential for volatility. We could then see potentially these companies crash in terms of our investments. And so the FANGs of the world want to ensure that we have the right focus on the types of investment you're doing and how they're backed. So FANG being Facebook, Amazon, Netflix, Google type companies that we traditionally think are amazing to invest in. But again, they are speculative because they aren't actually backed by something. Now, cybersecurity is going to be a big piece and will continue to be, especially with AI. So if you're a business owner, consider getting cloud cybersecurity type insurance. It's an additional expense, but something that you can really do to circumvent that, as well as personal cyber threat type insurance and identity theft as well. I use a company called Aura. I'll put a link for that below. That's been a lot better personally for me. Instead of using the LifeLocks of the world, just more features, better price. I also have it for my family, so that's been great too. But in terms of cloud computing, we've seen how there's a need for AI, right? And then really the need as well for cybersecurity, and how we're not going to allow these attacks really impact our business in whatever capacity. Now, cloud computing is also going to be, as it relates to the data centers, right? And those are things that are expanding. There's a lot of energy and a lot of power that's being used and needed for those. I'm having some conversations with development initiatives and companies who are looking to not only create these data centers and lease out some of that space, but create these data center kind of communities almost, where you also have like renewable resources and take direct power from oil and gas as well, to bring that energy in, keep these servers and equipment cool, and ultimately be able to have the type of cloud computing needed for the AI that is desired. So keep some of those things in mind, and the most that you can do in terms of, again, investing in terms of assets, not necessarily in terms of speculation. As we look into then the energy space, specifically oil and gas. Now, this is an industry that I'm very familiar with, as we've been raising funds for oil and gas opportunities to help high income earners offset their taxes and give themselves cash flow while also being passive, traditional to real estate type passive investments, but ultimately with better returns and more advantages. The oil and gas industry is expected to expand, as well as take a little bit of the consumption from current renewables. That's simply because this current presidency is then to say they're very focused on bringing things American created and funded and benefited, which is sort of a rebound to the traditional energy market. This is something we've seen as the opposite to the renewables for the wind, solar, electric type pieces. Although those will still be in play, those expected kind of incentives are likely to go away. And ultimately, the power sources will be more relying on oil and gas. This is also traditional for a state like Texas, which has a lot of oil and gas exploration and exportation. And they really found that with their power grid, it's best to rely most on oil and gas and not on the renewables, simply because they are inconsistent. So if any of you experienced the Texas freeze in kind of the 2021 and kind of continuing years, we really see that there's a number of different factors that impact energy consumption and the need for consistent energy, although we potentially want to offset some of that exposure with renewables. Renewables, again, ultimately are inconsistent and something that we need to consider, especially as we look to investment. It's also typically a longer payback time because there's highly capital intensive project and you're getting bits and pieces over time, versus oil and gas is a highly intense capital project that you're getting large amounts of pieces over time based on per barrel prices. And it's projected to, at least with this presidency, continue to stabilize and, like I said, increase, especially as we think about tariffs that are coming into play for a number of different countries as well. As we look at kind of finance and overall cryptocurrency, we recognize again that this industry and presidency is the most pro crypto that we've seen to date. And so, although I'm not necessarily advocating you invest in cryptocurrency, it's definitely something to consider to offset with diversification. If you are an individual who doesn't have a number of different like real estate holdings or whatnot, I would recommend at the maximum doing a 5% of net worth. So net worth is going to be the total assets that you have categorized in averages from a number of different sources. Don't just, for example, go on Zillow and be like, oh, this is the top price, right? Really get those averages between maybe the Zillow, the Redfins, and others of the world to then subtract the debt that you have. And that difference is going to be your net worth, right? Then 5% of that is the maximum amount that you should consider investing into cryptocurrency. If you already have assets, now you could potentially expand that to 10% if you're really bullish on it. But keep in mind that traditionally, because again, just like AI as an evaluation standpoint, that's not necessarily a backed asset type of investment. Therefore, we want to be considerate and not over leverage and say, I have, a positive net worth and I have a, chunk of change in my savings and checking account. Oh, I'm going to like liquidate one of those and put that into, say, the Bitcoin. It's not, recommended by any financial professional as well as my own self, finances. There is an interesting Bitcoin fund that I've been in conversations with. So reach out to me if you'd be curious about that, simply because we're mining Bitcoin at a lower price. And so that is then a way, as we consider from investment standpoint, to have a lower priced average as opposed to traditional market price. Same thing with real estate, right? We're getting an off market type property instead of an on market type marketed price. So there are those types of opportunities. If you know really the right people or have enough investable assets for that, that's going to be, a larger sum of money, call it say 50,000 plus that you would put in, but certainly are those opportunities. If you don't have real estate, again, you should be really, I'd recommend like a 2 to 3% of net worth. I know it's very exciting to, put some of this money in and you've seen the trajectory it's going previously, but ultimately, again, because there's no physical asset that's behind it and it really is based on speculation, you could be, taking your lunch, right? And so if your lunch is taken, then you have nothing to eat. You might have some stuff at home, but again, it's more of a gamble than necessarily a return. You want to do asset-backed types of investments. So think of real estate, think of oil and gas, and other types of funds. Those funds could be debt funds, for example, and something I'll talk about more in other videos. With overall the cryptocurrency kind of blockchain sort of phase, we also need to consider the banks and finance sort of perspective for this year. And that's simply going to be that they are very going to be much focused on the customer experience because of worsened profitability. Ultimately, with different investment opportunities, you then have less, more likely, deposits in your bank account. That's also going to mean that because of inflation the past couple of years, you've probably not really changed your spending. And so again, you have less in the account. So ultimately, if we can help increase the deposits that are being made by improving the customer experience, potentially offering different products, that's going to be advantageous to banks. So don't be surprised if you see that. And part of that sort of play is going to be deposit innovation. So things like save now, pay later, those things are going to, give the opportunity for, individuals like yourself to potentially buy bigger things or more things over a period of time. Again, extreme caution with this because it's really, future debt that you're bringing on that you are saying right now, I'm not able to pay for it. If you're leveraging it, it could make sense. But again, that's traditionally of highly astute and aware financial professionals and investors who are intentionally leveraging and, playing that to go invest in other things instead of just, for example, paying cash, or again, they have enough cash flow to do it. So if you're not able to pay with cash flow and you won't be able to pay with current, future payments, would not recommend doing any of these kind of save now, pay later. That's more of an extent if you need to change your expenses as well as also change your perception of how you're going about these expenses. Do you need that, for example, $3,000 a month, lease, right, for an apartment, right, is really what I'm thinking, or that $1,200 a month kind of car payment? We really think that those things will bring us, joy and advantageous value into our lives. And sometimes they certainly can. Think of, for example, that sports car, you then go to that, car meetup, you meet, other business owners, things like that, that could be certainly beneficial. But that, $3,000 a month type lease in an apartment, when you could, easily do a, $1,500 just nice, safe, simple type of property and really a home. Consider that, especially as we're, although certain for 2025 that there's not going to be some sort of change in terms of the economy. We all know that, for your specific situation that could, and the difference between maybe a $1,500 or $3,000 a month lease could be detrimental, especially from a car payment standpoint. So especially with cars, always recommend having that be lower. And in other videos, I talk about when and how that's beneficial to have those different types of cars or that lease and make it be a piece of value, not necessarily a piece of debt or expense that's kind of hanging over your head that if, finances go sideways, you're going to, lose your mind and potentially your marbles in the process. The other thing I've really seen for projection of 2025 is real-time processing to become more of a norm within the banking system. Now, I wouldn't necessarily count on this or really utilize this. Part of this is my own kind of fear, really issue or experience where I specifically had an issue with Wells Fargo a number of years ago, almost a decade ago, simply because they do allow kind of that real-time processing. But turns out that check came back as fraud. My account was overdrawn. A number of issues happened. And I really found that the best way to go about in terms of processing funds is to ensure that they validate and confirm those funds are actually the case, whether it's a check deposit in terms of, maybe consulting fees that I'm engaged in, or potentially it is an expense that needs to be taken out. Want to ensure any checks or any financial things are true by nature, so that way I can actually project what's actually happening. Again, why I'm such a big advocate of having a bookkeeper to really help you with your business, or if you're just a current employee, really to help you with your life as well for managing current expenses. Now, these are things to watch out for. Again, we talked about how things could be overvalued. Inflation could also come back in some ways and eat into returns. Diversification ultimately is your safety net, but it's after you've had your main kind of cash flowing piece and thing, right? So whether that's diversification in terms of, or that initial chunk within real estate, or potentially it's within business or kind of that W-2, income, taking that and leveraging to then go into these different diversification strategies can be advantageous. But again, you don't want shiny object syndrome and really investing in a number of things. You really want to keep it to kind of 2 or 3 main, and then you have 1 to 2 other things that you're diversified in, that you've done your research, it validates your investment thesis, and you go from there. In another video, I'll talk about investment thesis, how to create that, form that, and even a kind of guide around that. So stay tuned for that and be on the lookout for those sort of resources in future video. In the early part of 2025, we've seen how there have already been some layoffs and several factors have been impacted, with that. So as you're thinking about investing, don't just look at what you have today, but again, as you're potentially reducing your expenses and increasing your income through diversified investments, consider the understanding of the same may not be true, right? So you may not continue to have your job, even though, things look, shiny and rainbows and butterflies on the outside. So keep that in mind. Don't liquidate, your cash portfolio or, other investment strategies to go about that. Traditionally, we only want to invest a small chunk of really liquid net worth into projects. We don't want to do all of it, and it should be pieces of it. We shouldn't take the full 50. If you're doing 50+% of your cash reserves and liquid cash flow, it's not advisable. You should really stay at the kind of high income level. So you have $1 million plus. You should really keep things diversified in terms of 10% per allocation if you're investing in specifically syndications, and if you're below that threshold, then looking more at that less than 30%, you'd want to put into a single opportunity, so that way you can ensure that you build a foundation with good investment options and not just putting it all chips in the center to one piece and it not go well, and then all of a sudden you're out 50+% of your liquid net worth that you probably spent the last 3 to 5 years, I'm guessing, kind of building up, right? It's not good. And with the current kind of real estate market, it's going to change as we've seen really kind of 2020 plus, right? Or even 08 or to 2012, and then 2012 to kind of 2015, 2016, and a number of these different changes. It's going to be dependent on the market. Ultimately, the right investments could also be in the worst markets. So always keep in mind that it's not just the market itself of like real estate holistically, but it is also the deal itself in terms of what you're paying for it, what the rate is, also what the after repair value is, and the appreciation over time projected, but not leaning too much into that. One thing I did want to share as relates to rate, because oftentimes I hear people get really stuck on this, and it's on the fact of 30-year mortgage rates. So anytime it's, I have a couple loans that are the, 2-3%, and anything above that just seems like ludicrous. Like, why would I do this? But it's simply to say over the past 30 years, right? So think 1971 of sorts, really to 2025. The average 30-year fixed mortgage rate was 7.72%, and over the past 10 years, it's been 5.825. So as we think about the desire for it to be lower, also consider that by not being in the market, we're not able to ride that appreciation, use those tax deductions, create that passive or semi-passive income for us to really enjoy. And that's part of the reason how I was able to, increase my net worth. So keep those things in mind as you're considering investing in real estate, either passively or in direct investments. So those are all the things I wanted to talk about as it relates to this year for, 2025. Do you want to reduce your tax bill and invest smarter? Oil and gas is something you've potentially heard about, but here's the thing. Oftentimes, oil and gas operators rely on the fact that you aren't familiar with the industry. So I went ahead and created an ebook to educate you specifically on the different types, the advantages, the potential risks, and when and how to invest, as well as how to analyze these opportunities as well. I even give examples of some of those opportunities so you can see real world what that looks like. Now, if you're thinking about what those advantages are, it's going to be 100% of the investment that you make can be used to offset taxable income, which is going to be active income. And next, we're going to go into personal financial strategies that you should really focus on for this year. Here are the 4 things that every investor should do every day to protect their financial future. Now, this is something that I've experienced over the course of my investment future, owning several businesses, being a co-founder of a company, having real estate, being a commercial real estate broker, etc. And I'll go more into the depths of these things in a different video, but I just want to give a high level here because it's important for 2025. And that's simply the aspects of budgeting, saving, investing, and then having some additional sort of income source that is going to help prepare you and really just, I think, live life in some ways. So as we first focus on budgeting. So when we're thinking about budgeting, it's a matter of what we need, want, and desire. There was a period of time where I was able to save about 40% of my gross income. That's because my expenses did not change, although my salary at the time did. And so as we are potentially increasing salary and income, it's not necessarily having that be that like lifestyle creep. Certainly that's more challenging as you have a family and kids, things like that. There's just those sort of expenses. But it's also to say, like, how can I, take or be on a boat or something like that, as opposed to maybe buying the boat, or a number of different thoughts that we can think about as it relates to travel and experiences and fun and joy. And so although we could certainly plan to be you the type of person who's then spending for these types of things that you want, maybe we're thinking about, really nice house, really expensive fun car. Those things can also be achieved in different ways. Or maybe you're renting that fun sports car as opposed to purchasing it, or you're getting that affordable house so you're not house poor, and you're able to increase your investments such that you can rent that super nice house in the future. So dive a little bit into this. Ultimately, you do want to be budgeting to save 20% of your income specifically dedicated towards investments. So this isn't a just savings account for just kind of personal expenses that may, come up, kind of that emergency fund, right? That's something that is separate and beyond this. So if there was a rainy day, this is something that you would not tap into. And so part of helping that is understanding what types of expenses could happen over the next 1 to 3 years, potentially, new tires, potentially if you have that older vehicle, kind of a transmission change or something like that, right? Take that number, average it out, say over the next 2 years, and then you're going to have a monthly kind of saving budget piece. So you should already have that 3 to 6 months saved, but you should also in your budget have the ability to focus on constantly adding to it. So that way you don't just have a chunk of change and it gets kind of depleted. You're constantly adding to it and keeping your investment portion different. Part of this is also going to involve a higher consciousness and intention for you, right? If you're unable to say maybe budget or save 20% of your income now in terms of the expenses that you have and, kind of debt consolidation, what have you, then the next thing is going to be income creation. So that's something also we'll talk about on a different video, but it is something to keep in mind, something that I pursued, and I found a career that I was able to accelerate that. And ultimately, over the span of 4 years, I was able to double my W-2 income, which of course was easier to certainly save that 40% gross income, but it's certainly an important piece to focus on, that it's not just decreasing expenses, getting into a scarcity mindset, it's creating an abundance mindset and a income-based advantageous focus with either our current time or our additional time, right? So maybe it's kind of those nights and weekends that you're building that business that is growing or creating income, as well as using those investments to give the cash flow or assets that you're purchasing, maybe with real estate, maybe even you're buying a business as well. I know a lot of people are focused on that, but it also needs to align with your 3-year vision, which is another thing I go into detail in another video as well, and I have a resource on that too. So keep that in mind. I talked a little bit about the idea of an emergency fund. So from my viewpoint, this is more of a 3 to 6 month type of emergency fund. This is also assuming that I have lower expenses. So if I'm making 10 to 12 grand a month, my expenses are say a third or a fourth of that, and so I'm able to keep that a little lean. I personally have a whole life cash value policy that I also have that next kind of 6 months as well. So that way, if all reserves go out for properties and for personal expenses, I also have that kind of backup lever that I, if so needed, could pull to get a loan from that, and that would come back. And that's again a little bit part of my investment strategy as well, which I can dive into more detail too. With the expenses piece, right? And part of this is a little bit from a budget standpoint, is also the idea, right? I said difference between need, want, and desire. So as we think of what we need, it's then challenging us to think like, do I actually need this, or is this something that I just want, right? Maybe it's that new, bag, or it's more consumption, or maybe it's that eating at these certain places or things like that. But really understanding what's coming in and what expenses are then going out. Again, going to be beneficial to have some sort of bookkeeping or just reflection on your personal finances for even be aware of this. But also on this idea that something I've implemented is Project 333, which is a minimalist challenge where you wear 33 pieces of clothing for the next 3 months. And what this ultimately helped me do was actually reduce what I really felt like I needed. And now from a consumerism standpoint, in terms of like, oh, do I need 7 shoes and 5 belts and all these things? I don't. It's actually really given me a decrease in terms of clutter, in terms of my head, as well as with laundry, as well as, kind of logistics and thinking of what I'm going to wear. And also, I don't feel the need to constantly have this one type of specific shirt that's maybe going to kind of be a thing. In a lot of ways, that is a hoarding type of aspect, and isn't a sense of abundance. It's more of a, misalignment, right? Where, the things that you have isn't necessarily going to create more abundance. It's more of how you think and what you already feel valued with, and then also what you're going to create. So for example, if I was not someone of gratitude, but I was constantly wanting, that would never be fulfilled. And so I'd constantly go for more, try more, be more. And I'm not, from a homeostasis standpoint, I'm not secure and validated within myself. That's a challenge, because then I would go out and constantly try to validate myself with consumer shopping. Right? That is then going to obviously be more difficult with budgeting and how I view things. And I've even found in some ways how I treat people, right? If I'm constantly looking or needing the best, greatest, newest type thing, am I also valuing who's around me? Not just the things around me too, but different sort of perspective wanted to put into place. With investing itself, there's certainly the idea of dollar cost averaging, and that makes sense from kind of a stock or maybe sort of a Bitcoin crypto sort of standpoint. But it's also looking at when and how to invest in different real estate type assets, as well as different syndications and specific funds. These funds traditionally are for accredited investors. Accredited investors are simply defined as those who make $200,000 a year and are reasonably likely to do that over the next couple years, or they are married and collectively there is a $300,000 income for the household. They could also potentially have a $1 million net worth excluding that primary residence. That also makes an individual accredited. Now, at the accredited level, putting into these private placements, you're traditionally going to have a minimum of $50,000 in terms of what is needed to invest. There's a lot of opportunities to do a Roth IRA type transfer. I wouldn't traditionally recommend it. It comes up in conversations I'm having in the investor group, but traditionally people just get so excited that they're able to take their Roth IRA, convert it, invest it in to these types of projects. Those projects potentially go down for zero because they didn't do the right research, or maybe just something kind of black swan happens, and then all of a sudden, bam, they're out of that money completely. It's not like a stock, right? A stock, if it goes down, it's probably going to go maximum maybe like 30%, right? When you invest in these private placements, although there are great returns in terms of cash flow, tax deductions, and upside, there is the potential where, again, you could lose everything. And that's why it's important to do the due diligence, and something that I'm really passionate about and help people with as well. So keep that in mind. And something else as it relates to investments, as we think about investing, part of that could also be paying off that high interest debt. But we ultimately want to get out of debt and out of that mindset that we constantly need more, and going about that. So there's a difference between, for example, me paying off a 6% loan than me going out and getting a 10% return, right? That delta between the 10% and that 6% is then 4. That 4% is then a margin delta, and that is then increased instead of just the simple 6% if I was to pay off that loan. So there's a number of different factors here, and it's going to be kind of an analytical waterfall method in terms of when to pay what debt or how that's going. But ultimately, if you're increasing income in some aspect, you're decreasing expenses, you're aware of what really debts and kind of needs you have, you're then able to more beneficially offset the opportunities that are in front of you, and also empower those opportunities that are in front of you. And so it's sometimes better to maybe pay off that high interest, say maybe 17% credit card debt, than it would be to invest in, say, the stock market, like an S&P 500 type of ETF. Traditionally, it's going to be about 10% annualized returns. Paying off that 17 as opposed to that 10 is more beneficial. However, that's also assuming that you're not constantly adding to that. Now, one thing I've experienced with specifically credit card debt that I've used to leverage and furnish my short-term rentals is actually debt consolidation. So it's something I'll talk about my experience with in a different video in more detail. But instead of just paying off that amount, you could get a personal loan, right, which would show on your debt to income ratio. Especially if you're buying real estate, that's a big challenge, right? Yes, you're going to pay interest on that, but those loan rates are a lot different than what that credit card would be. On a debt consolidation loan, you're basically going to take a temporary hit on your credit, and then have the debt consolidation company negotiate with the credit card companies to only pay a percentage of that. And then you're going to pay that debt consolidation company, once it's finalized, a percentage fee of that. And so there's advantages of that because it doesn't show on your credit. Yes, your credit score is going to be tanked for, call it, 3 to 6 months. And then, we'll slowly come back, especially as that credit's been removed because it's been negotiated off. It's not bankruptcy. Bankruptcy will fundamentally hurt you for at least 7 years. It's, bankruptcy light, if you will. I really don't want to call it that, but in some ways it kind of is, where it's a different types of negotiation. Instead of you admitting, kind of this defeat, you're negotiating this, situation, if you will. So lean on things like that. If that's of interest, I can also put, information on that as well. Okay, here's the next hook. Your tax professional is killing your tax savings and your investment returns, and so are you. If we're looking at what your tax professional has in terms of skills and ability, it's really important to remember these 3 things. So first is simply going to be, are they actually a tax strategist, or do they within their organization have the ability for tax strategy? The next thing is going to be in terms of investment. Do they have an understanding of what types of investments you could consider? Private placements, alternative investments is a big thing that, I've been focused on, simply because most don't actually understand it, and also most don't invest in it. So how, as a professional, can you give guidance on how you could offset 100% of the investment proceeds that you make into an investment to offset your active income? For example, this is within oil and gas. You typically can get about 80%, or it really depends on the details for real estate, et cetera, et cetera. And the third piece is simply going to be, they have an understanding of specific opportunities as it relates to you as a business owner, or maybe just as a high income earner, and they're able to take those things that they're experiencing in the 8 and 7 figure sort of business worlds with their other clients and bring that potentially down to you if you're at that lower scale, or again, have that sort of piece. So if they're only working with people that are at your level, that's then going to be a challenge because you're only limited to their experience. And if they're only they're only really experienced with, for example, real estate or business, they're also not necessarily going to know about battery, oil and gas, and other alternative investments that could be added to your portfolio. Again, another reason why created the investor group that we have. Okay, so how are we preparing for policy changes in 2025? Now we have an understanding of what potentially is going to happen. We have the right, tax professional as well as financial professionals in and around our lives, or again, we have that sort of resources with other people for what and how they're doing it. The next piece is going to be how we're actually preparing for it. And so that's really going to come down to the Tax Cuts and Jobs Act, which again is set to expire this year unless ultimately changed. So the tactical ways that we're going to go about that, again, are what we previously discussed in the video. So review some of those as you might need. And then as we think about opportunity zones, I wanted to touch briefly on this in this video, and that's going to be that they are projected to be, again, canceled or stopped, right, December 31st of 2026. So now in 2025, that's going to be the best opportunity for you to understand them, if it's an advantageous thing that you should go after and really pursue. So let's talk briefly about what opportunity zones are, how you would invest in them, and things like that. And working with professionals who have actually had the experience, I wouldn't necessarily recommend the average everyday investor really do that themselves. So opportunity zones initially came to be in 2017 through the Tax Cuts and Jobs Act. And they ultimately give, specifically with real estate, the ability to defer capital gains 10 years after the holding of that property. A complete exclusion of the capital gains. There's also a 10% exclusion for previously deferred gains if the investment is held for at least 5 years, and then an additional 5% exclusion, so a total of 15% if the investment is held for 7 years before the deferred gain is recognized. So keep some of those numbers in mind in terms of timeline and returns as part of your underwriting proceedings. There's also rules and regulations in terms of how you would create a qualified opportunity fund that's invested, and you have to have significant capital that comes in that improves that property in that space beyond of what it originally was, which again, why there are so many, tax advantage is around it related specifically to capital gains. And it's important to keep in mind that the gain originally deferred will preserve its tax attributes until it's recognized. So there's a difference between short-term capital gains with opportunity zone investment and also long-term capital gains. So keeping those things in mind, talking to industry professionals as well as your CPA to understand how those could potentially be. So need to keep those in mind if you're looking at opportunity zones. It's a potential that something like this could be expanded, because this ultimately ensures that there is reinvestments into communities that are not as affluent in some ways. And although that can lead to things like gentrification, and regardless of the political or community impact, again, this is just the fact in terms of what opportunity zones are and how you could look at in terms of investing them to really prevent the capital gain that you would have for this property. Again, assuming that you kept it its full 10 years, that's really where the maximum benefit is. Stop overthinking what could happen in 2025. It's not the timing of the market. It is the time in the market. So we've gone through a lot of different things of what could potentially happen. There's some speculation on what things, could change or not change. Trump, from at least the original time he had in office, he was very action oriented, and he seems that way as well. And so we'll see as the year unfolds what comes to be the impacts of that and what things are going to continue. Maybe if there's some discussion from, the Democratic Party or other individuals in the different, Congress or House for things that he, wants to enact either through executive order or through vote. It's important ultimately, regardless of what happens on the macro political piece, to also think and look at the macro economic piece and also the micro being essentially yourself, your community, things like that. even if things were drastically to change, you need to prepare ultimately for yourself in terms of what you're saving, what you're spending, what you're investing, how to go about investing, not sure, or making sure that you're also not over leveraging for investments. Again, for example, we're not taking 20% of our liquid income or liquid, cash reserves and going to invest that into Bitcoin and just seeing that be. If we are able to really increase the income that we make to offset the initial investment and then extract that, those things can make sense. But certainly, I'm not sure those who could, really predict the future in investments, who want to do the right underwriting. We also want to have the right consciousness, lack greed, and ultimately make the best sort of investments. And part of that is also going to be playing that long-term game. Again, reducing expenses, increasing income, and not having a need for constant investment, but really focus on the best investments with where we're really at in how we're growing our net worth and certainly our cash flow. And there's numbers of ways, to do that: buying commercial property, buying businesses, as well as simply buying single-family homes where you're renting it short-term, long-term, or even mid-term rentals. But sometimes those can be challenging as well. In addition, that they aren't typically passive. And so looking at potentially passive income opportunities for either equity multiple, cash flow, tax savings, or a combination of all three are going to be a beneficial piece for you to consider for 2025. So again, regardless of what happens, we are prepared and aware to then take action as it comes to be, because ultimately one of my favorite quotes is simply that luck is preparation when it meets opportunity. So be prepared, recognize those opportunities, and ultimately you'll get lucky for 2025 and beyond.